We are going to kick us back off with Nasaji from Lendr Network. So get back in the zone, everyone. Thank you. Hi there, everybody. Perfect. Hello there, everyone. We are Lendr Network. We're doing synthetic real-world asset tokenization. And this is essentially just a new way of tokenizing real-world assets that allows us to tokenize any asset class while achieving higher yield, lower fees, and global access. And I'll get into exactly how we're doing that. So a quick introduction. My name is Nathaji Metivier. I'm the CEO and lead developer of Lendr Network. And I have been involved in crypto for a little over 13 years. And I was introduced to it in a very unusual way. It was actually through a Craigslist ad of someone offering to give away free video cards if they could run some secret software on your computer. And at the ripe young age of 17, I was very interested in a free video card. So I emailed them. And they wouldn't tell me what the software was. So I didn't trust them, but they gave me enough information for me to make my way to the Bitcoin Talk forum. And that's where I learned about Bitcoin and mining, and I started mining myself and actually running up my mom's electricity bill. And she's sitting right back there. And the other members of the team here, our CMO, Al, has 32 years of marketing experience. Our COO, 24 years of operations experience, and our head of engineering, 12 years of software development experience. All of them have also been involved in crypto for over 7 years at least. We're part of the Codebase accelerator and also the Chainlink and Brink/Animoca brands accelerators as well. Mm-hmm. So if you have been in crypto as long as I have, you very likely have had the experience of waking up one day and finding that 25% of your assets have disappeared overnight, which is not the greatest feeling in the world. And the reason that this happens is because you are not properly diversified. So Ray Dalio, the founder of the world's largest hedge fund, says that diversification is the holy grail of investing. And the reason for this is because if you can diversify into uncorrelated asset classes, you can reduce your market risk by up to 80%. The problem is that it is currently impossible to reach that level of diversification within Web3. And the reason for that is the asset classes are just unavailable. You can't access them on-chain. So you have to use off-chain solutions. And the series of steps that you see on the right-hand side are actually what you had to go through in order to diversify off-chain. And in my previous company, we had to go through those steps many, many times. That process overall can take up to 14 days and has a variety of fees and gas costs associated with it each way. So when you're leaving crypto and you're coming back. And the last problem that we see here is that for on-chain companies that don't have a bank account, they simply can't do this diversification at all. And so there are currently $30 billion sitting in treasuries today on-chain that are not diversified. The second issue that we see is there are a number of RWA protocols aiming to solve these problems, but each of those protocols has a number of issues with them. The number one issue being that a majority of them only tackle one asset class. So they might do private credit or real estate or gold, and that's pretty much it, maybe treasuries as well. But if you compare that to the stock market, almost every asset class is currently unavailable. The second issue that we see is that they are not actually creating RWA tokens. They're creating investment pools, so they'll take your money off chain, they'll lock it up for you, and they'll give it away if it's private credit for them to earn yield. And the problem with this is that tokens are really the building blocks of Web3. Every protocol is built on top of tokens. And if you don't have those tokens, people cannot build using RWAs in Web3 at this point in time. And so you can imagine a scenario where stablecoins decided not to actually make tokens. Instead, they made cash investing pools or something like that. There would be a huge number of protocols that would not exist today that currently use stablecoins to run. So that's an issue that we're aiming to solve. The final issue that we see is almost every one of these protocols is centralized. So there's huge regulatory risks, especially here in the United States, and a lot of accessibility issues as well. So you can't access them here either. Despite all of these issues, RWA TVL has grown 60% just this year. And the market is slated to reach up to $16 trillion, the T, by 2030. And to put that into perspective, all of crypto right now is around $2.5 trillion. So this is at least a 6x increase on the entire crypto market. And these predictions are coming from traditional finance entities like Bank of America. So our solution to these problems are Lendr Network. Lendr Network essentially creates fully decentralized RWA tokens for any asset class. And we have a unique tokenization method that allows us to achieve higher yield, lower fees, and global access. And really our goal is to not just bring one or two asset classes like what you see with other protocols, but really every single asset class is, to the chains like Avalanche that we'll be launching on. Good. So getting into how exactly we're doing that, we create these RWA tokens They function a lot like ETFs, and essentially they just give you exposure on-chain to these different markets. And we want them to be the simplest way to diversify within Web3. You just swap to these tokens the same way you swap to a stablecoin, and you immediately have exposure. We also allow you to stake these tokens in our protocol to earn additional yield, and we mint for you a liquid staking real-world asset token. So this is a new primitive. And you can essentially use these tokens in other protocols. And this is how we get higher yield than what's available in Web 2 and Web 3 today. Our key piece of innovation is that we're using synthetic tokenization. This is essentially the same method used by decentralized stablecoins to create their tokens. Just fancy terminology that means that we're backing these tokens with on-chain collateral. This is really beneficial for the chains that we launch on, because if we want to mint $1 billion of real-world asset tokens, we need to hold at least $1.1 billion of on-chain assets to back it, which is really good for on-chain CDL. This synthetic tokenization also allows us to capture the ethos of Web3, which is really full decentralization, community ownership, and no middlemen. And that's how we achieve lower fees and global access as well. Our vision for this product is really to make every traditional finance asset available on-chain without compromising on DeFi yields. So obviously that number at the bottom is pretty high. Normally would be something of a red flag, but we break down here exactly how we can reach this level of APY. You're getting some returns from what you would get from an ETF. You're then able to stake in our protocol to receive a little bit more, and you receive that liquid staking token as well. You can then take that to another protocol, like our partner Benki, and lend that out to earn additional protocol on top of it. And so by combining all these different forms of yield, we're able to achieve yields like this. These are based off of historical averages and existing on-chain protocols today. I don't have too much time left, so I'll breeze through these last few slides. We're going for an untapped market, which is these fully decentralized RWA tokens. And the real benefit of this is that there is a huge shift in US regulation right now. So just last week, the House of Representatives passed the US 21 bill. And this is a 250-page long bill that CoinDesk says is the most important piece of legislation related to crypto that's ever been passed. And it clearly lays out how decentralized protocols can have UX access while not qualifying as securities. The SEC also has made a statement saying that if you are sufficiently decentralized, your tokens are not securities. We're going for a fully decentralized approach. And with that, we're hoping to be able to access the US market before any other RWA protocol can. And that's including more than just accredited investors. Looking at our traction, we launched a pilot recently. It was a US real estate token where we generated over $130,000 of revenue. And that was from 5,000 or more than 5,000 paying customers. And that was with no marketing spend. So it's just all organic. We have DeFi integration commitments from Benki, the largest protocol on Avalanche for DeFi, and a link to Perpetuals Exchange, and we'll be expanding that list soon. Multiple first place hackathon wins and multiple accelerators. We're currently fundraising. The round that we are looking at right now is actually our pre-seed round, raising $500K at a $20 million valuation. And we're actually oversubscribed for that round now at this point in time. So we'll be having our next round, our seed round soon, raising $3.3 million at a $30 million valuation. We have $500,000 committed to that round already. And that is Lendr Network. Yeah, so if you guys have any questions, I'm happy to answer that.
What do you think, what assets do you think have the most interest? Like there's obviously a ton of wealth on chain. I agree with you about the diversification piece. So in terms of, I didn't see a roadmap in here from an asset perspective. What does that look like?
Let me see if I can get to the slide that I have on the different types of assets that we'll be listing. Oh, that's it. There we go. So we wanted to approach this in an intelligent way because since we're doing synthetic tokenization, we can really tokenize anything. But that kind of leaves the door open to say like, okay, what should we start with? What we decided to do was look at the largest existing ETF markets because this is already a well-established multi-trillion-dollar industry. And simply say, okay, what is currently unavailable on-chain? We can bring those on-chain. We know that people already want to diversify into these asset classes and very likely want to build on top of them as well. So these are the asset classes that we want to start with. Real estate and electric vehicles will likely be our first two tokens. And then from there, we want to do healthcare, energy, and then maybe some financial indices. Sure. Any other questions?
In terms of your liquid staking, RWA, how do you essentially get those liquid staking integrations? How do you get that accepted as collateral in other DeFi blue chips or protocols or whoever it is you're seeking to partner with?
For sure, yeah. What I found is really a lot of protocols would love to offer their customers real-world assets as part of their offering with their products. So it hasn't been too difficult, and very luckily, Avalanche has been able to connect us with a lot of existing DeFi protocols on their chain. We'll also partner with Chainlink, who pretty much everybody is building on top of. That makes it very easy for us to connect with different types of protocols to make these integrations. And then from there, we really want to just go and say, hey, you're offering stablecoins already. Your users really like using them, but they're losing 4% or 5% every year to inflation. They can instead stake a real estate token and be gaining 10 or 12% in APY on top of what your protocol is offering. So it's a pretty easy sell. Yeah, for the protocols at least, yeah. Mm-hmm. Any other questions?
So just really quick, are these replicating existing U.S. securities? Like, is this basically your technology or your real estate on the back end? You're kind of cash settling against the performance of real U.S. markets, or?
So we're using oracles to track a lot of data from real world assets, but we're not replicating existing securities and not basing them off of securities if we can avoid it for now. The protocol will eventually be fully decentralized, and then once a DAO is controlling it, separate from a centralized company, they'll have the opportunities to sort of tokenize things that maybe we don't want to start with. Yeah, so starting off with real estate and electric vehicles, we can do both of those without touching any securities. All right, yeah.
Thank you very much, Tony.
Great, no problem. Thank you.
Lines.
Yeah.